welcome to Global Online. Friends, in this video we are going to discuss some important MCQs on money and banking for your upcoming UGC NET. And if you are preparing for UGC NET in economics or any other state level set in economics, you can join our crash course. In this crash course you will get complete theory lectures, complete MCQs lectures, and entire syllabus mock tests are available with solution PDF. Then we are providing notes on all the units. Practice MCQ set is available. If you want to join, you can contact this number, or else you can also download our Global Online app from the Play Store. If you just type Global Online in Play Store, you will see the app, and by going through this logo, you can download our Global Online app. And in app, first you have to register by using your mobile number. Then you can search for the course UGC NET Economics. Then you will get complete details about this course. Then if you click on that, you can access the material. So here the first question is rapid increase in the price level during the period of recession or high unemployment are known as option A inflation, option B stagflation, option C deflation, option D stunt. So as you all know, when the price level is increasing, when the prices of the goods and services are increasing, and also there is an unemployment in the economy, this situation is known as the stagflation. So option B stagflation is right answer. Stagflation means it is the combination of both price rise means inflation and also unemployment in the economy. When both are increasing, that is known as the stagflation. A country's citizens are affected by the high rates of inflation and also unemployment. So this condition is known as the stagflation. The next question is the demand for money is option A the willingness of people to hold money at different interest rate, option B not determining by precautionary motives, option C the amount of money banks are willing to lend at various interest rate, option D none of the above. So here the demand for money means it is the willingness of people to hold money at different interest rate. It is known as the demand for money. So in monetary economics, the demand for money is the desired holding of financial assets in the form of money. Why people wants to hold cash? That is known as the that may be in the form of cash or in the form of deposits rather than the investing. So it is known as the demand for money. The third question is the quantity theory of money QTM is a theory of how option A the nominal value of aggregate income is determined, option B the money supply is determined, option C the real value of aggregate income is determined, option D the interest rates are determined. So the quantity theory of money, it is a theory of how the nominal value of aggregate income is determined. So option A is correct answer. So if you go through the QTM, the quantity theory of money, it is a framework to understand the change in prices in relation to the supply of money. So according to this theory, an increase in money supply creates inflation and decrease in money supply will create the deflation. The next question, the Keynesian theory of money demand predicts that people will increase their money holdings if then believe that option A interest rates are about to fall, option B bond rates are about to rise, option C bond rates are about to fall, option D expected inflation is about to fall. So according to Keynesian theory of money demand predicts that people will increase their money holdings when bond prices are about to fall. Sorry, bond rates are about to fall, then people are holding money. So according to Keynes, Keynes explained the asset motive through what he termed as speculative demand. In this theory, Keynes argued that demand for money is a choice between holding cash and buying goods. In an economy, if the interest rates are low, then people will tend to expect rising interest rates in the future and therefore a fall in the price of bonds. In this case, demand for holding wealth in the form of money will be higher. And vice versa, if interest rates are high, people will think that interest rates may fall. Then there is likely to be greater demand for buying goods and services instead of holding money. The next question is, the absence of money illusion means that option A has the money supply doubles, the demand for money doubles. Option B has the interest rate doubles, the demand for money doubles. Option C has the money supply doubles, the demand for money doubles. Option D has the price level doubles, the demand for money also doubles. So the money illusion, it is related to price level. So option D is correct answer. As the price level doubles, demand for money also doubles. It is known as the money illusion. So money illusion means it is the belief that money has a fixed value. Here we are imagining that money is having a fixed value. The inflation is not going to affect the money supply. Yes, and the effects of inflation are ignored here. So we are giving a fixed value for the money. We are not going to consider the inflation. Because of money illusion, during inflation, individuals may perceive an increase in nominal income as higher welfare. So when this is actually an illusion and their real spending power has not changed because prices have risen at the same rates as wages. So here just you have to remember that money illusion, it is the belief that money is having a fixed value and we are not going to consider inflation rate. The next question is, in case of Keynes theory, interest rate is related to option A saving, option B national income, option C money supply, option D money demand. So in case of Keynes theory, interest rate is related to money demand. So option D money demand is correct answer. The question number 7, transaction demand for money is proportional to option A income, option B rate of interest, option C money supply, option D investment. So transaction demand for money, it is proportional to the income. So as income increases, transaction demand for money also increases. As income decreases, transaction demand for money also decreases. So there is a proportional relationship between income and transaction demand for money. The same is mentioned here. Transaction demand for money, money needed to buy the goods and services. This is known as the transaction demand for money. And when when income increases, transaction demand for money also increases. Decrease in income leads to the decrease in the transaction demand for money. And when it comes to second one, that is precautionary demand for money, here money needed for the financial emergencies such as accident, marriage, etc. So here also there is positive relationship between income level and demand for money. So income increase, when income increases, demand for precautionary motive also increases, and if income decreases, demand for precautionary money is also decreases. And the third one is asset motive or speculative motive. So here there is an opposite relationship between speculative demand for money and uh, interest rates. When people wish to hold money rather than buying assets, bonds, risky investments, so it is speculative motive. So people hold money to invest in the future, such as in shares, bonds, etc. Match the following. Here one side liquidity trap, liquidity preference, invalid dichotomy, modern QTM, and this side Tobin, Piedmont, Don Patinkin, Keynes. As we all know, liquidity trap is given by JM Keynes. So A is 4. There is only one option, that is option D. So option D will be right answer. That is liquidity trap is given by JM Keynes. Then liquidity preference, Tobin, invalid dichotomy, Don Patinkin, then modern QTM, modern quantity theory of money was given by Friedman. The next question is, to which one of the following does the liquidity trap correspond? Option A consumption function, option B production function, option C money demand function, option D labor demand function. So very easy question. Liquidity trap, it is going to correspond to the money demand function. So option C money demand function is the right answer. So liquidity trap, as you all know, it is a situation when expansionary monetary policy is not working here. So you, at the very low rate of interest, people will hold money. So it is not going to stimulate the economic growth. Question number 10, assertion and reasoning question. Here the assertion is money is neutral in patent quantity theory of money. Reason is increase in demand for money leads to equal increase in supply of money. Four options are given here. Option A, both assertion and reason are true, and reason is the correct explanation of assertion. Option B, both assertion and reason are true, but reason is not the correct explanation of assertion. Option C, assertion is true, reason is false. Option D, assertion is false, reason is true. So here the right answer is option C, assertion is true here. Money is neutral in patent quantity theory of money. It is correct. But reason increase in demand for money leads to equal increase in supply of money. So this is wrong here. When demand for money increases, supply of money will not. So this here reason is wrong. The next question, near money is correctly defined as option A, asset which has 100% liquidity. Option B, asset which has no store of value function. Option C, asset which is medium of exchange. Option D, asset which fulfills the store of value function and can be converted into a medium of exchange at a short notice. So as you all know, near money means here option D is correct answer. Near money means it is not actually money, but it is working as money. It is assets which fulfills the store of value function and can be converted into medium of exchange at a very short notice. Very easily, in very less period of time, we can convert this near money into the money. Here you can see the definition also. Near money, or it is also known as the quasi money. It consists of highly liquid assets which are not cash but can easily converted into cash. Example, saving accounts we can easily transfer, money market funds, bank time deposits, government treasury securities, bonds, foreign currencies. These are all examples for near money. The next question is, which of the following is generally called as aggregate monetary measure of money supply? Option A M4, option B M1, option C M2, option D M3. Yes, aggregate monetary measure of money supply, it is M3. So please remember it. M3 is known as the aggregate monetary measure of money supply. So M3 means, as you all know, M3 consists M1 plus time deposits of commercial bank of M1 plus time deposits of banks. Question number 13. Who among the following economists considered the rate of interest to influence the transaction demand for money? Just now we have discussed about the transaction demand for money of J.M. Keynes. So here J.M. Keynes has considered rate of interest, here W.J. Baumol. So W.J. Baumol has considered rate of interest to influence the transaction demand for money. According to J.M. Keynes, income was the influencing factor of transaction demand for money, but W.J. Baumol considered rate of interest has the influencing factor to the transaction demand for money. The Baumol-Tobin model is an economic model of a transactions demand for money, and it is developed independently by William Baumol and James Tobin. These are the two great economists, and the theory relies on the trade-off between liquidity provided by holding money and the interest foregone by holding one's assets, that is in the form of non-interest bearing money. The next question is, assertion is monetarists disagreed with Phillips curve analysis, and reason is there is no unique correspondence of percentage inflation rate with percentage of unemployment rate. So let us move to the answer directly. Here the right answer is option A. Both assertion and reason are true here, and reason is also correct explanation of assertion. The next question is, the traders reduce the risk of loss in currency fluctuations through which of the following? Option A, speculations. Option B, arbitrage. Option C, hedging. Option D, none of the above. Here the traders are going to reduce the risk of loss of currency fluctuation through hedging. Option C, hedging is right answer. So hedging, it is an insurance like investment that protects you from risk of any potential losses of your finances, and hedging, it is similar to the insurance. For example, if we have an asset and we would like to protect it from floods. Okay friends, this is about today's session, and if you want to join our UGC NET or SET crash course in economics, here you will get complete theory lectures, complete MCQs lectures, entire syllabus mock tests are available, notes is available, practice MCQ set will be provided to you. And if you want to join, you can download our global online app from Play Store and you can register, or else you can also comment in the comment box. Yes, thank you, and all the